Hi there, everyone. Welcome to today's event. I'm Kat Delgadillo here to co-host our event with our CEO, Hall Martin, who's going to tell you a little bit more about what we do here at 10 Capital as soon as he joins. Hall?
Well, thank you everybody for joining us today for another great presentation here at 10 Capital. And before we jump into our first presenters, we'll have three today. I'd like to tell you a little bit more about 10 Capital. At heart, we help startups and investors connect for funding. Let's next slide. We help startups put their deal together. We help with fundraise strategy. We also help with valuations. We use several AI tools to analyze the pitch deck and other aspects of the deal to improve it. And at heart, we provide the legwork, saving you time and money. Next slide. In addition to that, we also help form capital for the early stage ecosystem. For high net worths, we are helping them start and run family offices. That's the purpose of today's event, and because they fund emerging managers where some of the best returns are found. Second, we help VC funds find limited partners, mostly high net worth and family offices. And third, we help angel groups find members. That's how they fund their program. So we're trying to form capital for the early stage ecosystem. Next slide. We have 5 online events we do each month, 4 online and 1 in person, I should say. We have the Family Office Roundtable. It's topics related to family offices for those who want to start and run them. 2, we have the Virtual Quick Pitch, which is for tech deals. And the Life Science Syndicate is for the life science deals. Investor education is across the board. We also have presentations around how to invest in different sectors. And then we have 1 in-person live event each month. We were in Dallas earlier this month on our way out to the Bay Area, September 18th. Next slide. If you're a startup and want to learn more about our program, just take a picture of that QR code and fill out the form. And we'll follow up to see if our program is a good fit for your fundraise. We'll do this online, so we look forward to your feedback. We will have a survey at the very end. If you could give us a few points of information, we would appreciate that. We always make decisions off these things, so it's really worth the time to fill it out. Next slide. We also have a great use of AI. We have an Investor Connect podcast program with over 850 interviews of angel VC family offices. We also have the Startup Funding Espresso. It is a short 300-word micro blog post, 1.5 minutes to listen to it or read it. And it tells you something about startup funding and investing and the time it takes to drink an espresso. We've taken all of that content and put it inside our own chatbot, which we call Ava. And so let's learn more about how it works.
Hi there. I'd like to introduce myself. My name is Ava, your personal AI venture assistant. I'm your new best friend in the world of investing in startups, the 10 Capital AI chatbot. I'm here to make your journey through the startup ecosystem easier, faster, and a lot more fun. Need help finding your next big investment? Or maybe you're a founder looking for fundraising tips? I've got you covered. I pull all my knowledge from over 500 blogs, countless podcasts, and even some nifty calculators, like the How Fundable Is Your Startup tool, to give you the answers you need. So how do I work? Easy. You simply go to where I live on startupfundingespresso.com and look for me in the bottom right. As soon as I appear, go ahead and click on me to let me know you're here. And then there you go. All your questions answered at your fingertips. Whether you're into health tech, biotech, life sciences, or any of the other exciting fields out there, I'm equipped to help you navigate the trends, challenges, and opportunities in each one. Got a question? Just ask. And guess what? I even pull insights from the 10 Capital Network podcast on Investor Connect. It's packed with expert advice, success stories, and more, all designed to help you succeed in the venture capital world. So what are you waiting for? Let's chat. I'm here 24/7 to help you find the right answers, connect with great opportunities, and make the most out of your investments. See you on startupfundingespresso.com.
Great. So let's meet our panelists for the day. We'll go ahead and start with Josh Love. Josh, if you can tell us more about yourself and your group and what you do, that'd be great. And then we'll go to Mohammed next and then to Ram third. Go ahead, Josh.
Yeah, I appreciate it. Thanks, Hall. Looking forward to the discussions today. I'm an angel investor located in Nashville, Tennessee. The 3 areas of expertise I always tell people I help with is tech, specifically software, and raising capital and then go to market. So I've been in sales for almost 20 years. I've seen a lot and worked with a lot of startups, help them raise capital and develop their tech roadmap. So looking forward to the discussions today and getting into the different decks. Thanks, everyone.
Great, thanks. Next up is Mohammed Hachicha. Mohammed, tell us more about yourself and your group.
Hi, everyone. My name is Mohammed. I'm the founder and CEO of Crown Acquisition Group. We're a boutique agency that specializes in finance, fractional CFO, and bookkeeping support for early stage VC-backed companies. Seed, Series A, Series B, we help them with fundraising, bookkeeping, and financial strategy. I'm here to help the companies that are trying to raise and see if I myself as an angel investor could potentially invest.
Great, thanks. And third, let's have Ram Fleury. Tell us more about yourself, Ram.
I founded a wealth management firm 40 years ago, mostly focused on high net worth and ultra high net worth. The firm had about 250 million under management. I sold the firm to an investor, and I'm doing it again second time. My focus is helping emerging private family offices. These are tech entrepreneurs who enjoyed a liquidity event. The wealth they bring to the table is really long-term, intergenerational. They're looking at the whole world of VC as a way to improve their total returns. In other words, they have a core, and this is an explore. And this is a way to join the frontiers of technology.
Great, thank you. So let's bring our first presenter up. We have Edward Bruce White of Combat Medical. Ed, please launch your slides and kick off when ready. For those in the audience, we have each one will have 10 minutes to pitch and then 5 minutes of Q&A. At the end, we're going to have a short presentation on family office topic, and then we'll have breakout rooms afterwards. With that, go ahead and kick off whenever you're ready.
Can you see my screen?
Yes, we can.
We can.
Great stuff. And you can hear me.
Yes, we can.
Absolutely. Thank you very much for inviting me and also for accommodating me to go first due to time differences. My name is Ed Bruce White. I'm the CEO and co-founder of Combat Medical. I've been with Combat since its inception. I built the business up with my business partner from the initial idea to what we have today. We're now a revenue generating business. We're profitable as well. We've raised $20 million to date, 16 million in equity, 4 million in government grants. This investment round is 5 million. We've got 2.7 million of that already committed, and I'll talk about some of the soft closes that we've had since a US recent roadshow. And this money is all to be used to pay for an FDA trial. As I say, the company is already profitable, so we pay for ourselves on a day-to-day basis, but what we can't afford is to pay for the FDA trial. It's going to cost 7 million to run the trial, but we're only asking for 5 million because the company will contribute 2 of that million. So what's the problem? There's been no innovation that's affordable, effective in the world's most expensive cancers, and that's bladder cancer, which we're going to focus on. We do deal with some other cancers. In terms of just stepping back about us as a business, one of the things that will be unusual you'll see today is that we do have commercial credibility. As I've said, we've got 4.3 million sales in 24. In 25, we're on track to show double-digit growth, 500,000 of EBITDA. And again, in 25, we're looking to extend that to a million. So we're a strong, positive business, knowing how to run the business. We've done over 100,000 treatments, mainly in university hospitals in Europe, across 35 countries. Got lots of publications to be able to support it, but we're missing what we call phase 3 registrational data for the US. We are approved in Europe, like I said. We've got key patents that cover the technology. We're the only company to be able to successfully deliver hypothermic chemotherapy. It's through biocompatible heat exchangers that we'll talk about later in the presentation. It's a platform technology, so we're focusing on bladder today, but we've also got a treatment that already is approved for peritoneal, and through $4 million of Innovate UK grants, government grants, we've developed 2 new catheters and systems that have gone through preclinical animal testing and about to go into human clinical trials this year. What we're talking about is funding of an FDA trial, and I'll talk about the FDA trial later in the presentation. Here's how the system works. We catheterize the patient in a bladder cancer patient. They're awake, and then we insert and recirculate the chemotherapy fluid for up to an hour. And what we're able to do is be able to really accurately deliver the temperature. And because we're delivering it just to the targeted organ, there's no systemic side effects. So we're giving existing chemotherapy drugs that are approved into the bladder. We get high perfusion, and it's all about the temperature control. This is enabled through our powerful patented aluminum heat exchanger and being able to control the pressure very precisely. You can imagine your wait for these procedures. And it's also to be able to fit in with existing clinical practice. We've done 100,000 treatments. We know that it works very well in Europe. We've done actually 20 patients in the US at Duke University, and it can be used with multiple drugs. So existing drugs approved, and then drugs that are in the process of being approved, we could be partnered with. We could be the catalyst to make them work. So like I say, we're drug indifferent, and it opens us up in terms of competition. In terms of why hypothermia, so cancer cells are more sensitive to heat. They get stressed at 106 Fahrenheit, whereas good cells don't get stressed to 111. And what this does, it activates the natural killer cells that targets the heat stressed cells. This is a normal reaction in a cell that creates a lasting memory. And then the science behind it, what's being shown in cells and by combat, is that we get 10 times more drug absorbed, the concentration becomes more potent and effective, and it just becomes more destructive and improves the overall treatment. That's being proved scientific in cells lines, and we've done that, and there's several papers that Duke University have published on a series of 40 and another 20 pigs that they did to be able to examine that penetration and confirm that you're getting the 10 times more as you would in terms of the science what they've done in the cells. So we start with the patient journey for somebody who has bladder cancer. They get diagnosed, they get surgery to remove it, transurethral resection it's called. And if they get high grade or very high grade, which is the cancers that we're focusing on, they will have 27 immunotherapy treatments over the course of 3 years. Has high side effects. 50% of patients will drop out of that treatment. So, and that's been the standard of care for 30 years. If they have low grade, they have chemotherapy. The chemotherapy by itself isn't as effective as the immunotherapy, but it's still reserved for low risk because it's no point giving them a nasty treatment because of the nasty side effects. But if I were to tell you that the standard of care then delivers a 50% reoccurrence, you're guaranteed that you'll have a 50% patients will have a reoccurrence within the first year, and 80% of all patients, which is why it's one of the most highly recurrent cancers and therefore makes it expensive. And you go around this treatment process until the cancer progresses. And once it progresses, then they'll remove your bladder, which is the standard of care. And then you have a lifetime of inconstant treatment, potentially losing your sexual function. So it's a really serious operation. I want to talk about serious operation. 5% of people will die in the first year, and 21% over that lifetime. So it's an expensive treatment, nasty treatment to go through. Our treatment is exactly the same. Diagnosis, surgeon does the same cancer, and then you have the 15 chemotherapy treatments, but this time we're warming them hypothermically. And the effect that has, it significantly reduces the reoccurrence and the progression rates. So I'll show you some clinical papers on this shortly. And that stops the cancer coming back, but ultimately it means that we're saving bladder. We're about bladder preservation. So here I'm going to just run through a couple of examples, but like I say, we've got over 40 publications now. This is 174 patients. It's exactly the same group of patients called BCG unresponsive that we're running our FDA registration trial. And you take the very worst, 54 patients with carcinoma in situ, which is a cancer that hides beneath the surface. We have a complete response rate at 12 months of 69.5%. That means 7 out of 10 patients are free of disease after 1 year of our treatment. And then if you look at another group, this is from Cologne University, another big series of 60 patients, and you can see 67%. So we're getting consistently the same number of results, as it were. The FDA require 100 patients for approval. In fact, 75 is the minimum. That's where some drugs have been approved at. So we're talking about this as meaningful data because the number of patients that we're talking about. This is a group called the International Bladder Cancer Group outside the American guidelines and the European Guidelines Committee. This is one of the most powerful groups of doctors, and they make recommendations for other doctors to be able to treat their patients. And they recommend when patients have gone through everything and they've failed all the treatments or they're inoperable, that they actually now recommend hypothermic mitomycin R treatment as a potential treatment. So, like I say, what does this actually mean for the patients? After 12 months of treatment with our treatment, 7 patients are still free of disease. That means, unfortunately, it's likely 3 patients will have their bladder removed. At the moment, we take J&J, which has got one of the most promising drugs that's not approved by the FDA, who's going through exactly the same trial that we're going through. only 4 of their patients are free of disease. And this is published data that they're using for their registration. That means 6 patients have had their bladder removed. And we talk about the competitive landscape. So Merck, with a first drug to get a drug approved for these BCG unresponsive, these failed patients. And it's a very successful treatment. Merck of Keytruda. It's been incredibly successful in lung and other diseases, and they're doing almost 30 billion in sales and growing annually. But in bladder cancer, they report a 19% complete response rate. Ferring with natafergine, another FDA-approved drug, they've done a $500 million licensing deal, which is now being paid out, 24% complete response. Immunity Bio, listed company, just got approved last April 24, 2 billion market cap, trading at that rate still, 36.4% complete response rate with minimal clinical traction, because then the complete response rate really isn't good enough for the cost and the side effects and the profile of the drugs. But now we're getting into the real competition, which is J&J. They spent 500 million buying TAR 200. They estimate they'll be doing 5 billion in sales, and they've got a 44% complete response rate. They haven't been FDA approved yet. And also CG Oncology, they listed for 1.8 billion off the back of interim results that we will have by the end of 2026 for 1.8 billion, and they've got a 46% complete response rate. And if we look at it from a bottom up of the market and a very conservative view, if we just take the BCG unresponsive patients in the US alone, it represents 10,000 patients. 15 of our treatments means there are 150,000 treatments available with a price tag of $4,000, which is significantly lower. If we take Immunity Bio, they're charging $36,000 per vial of drug. This is for the drug and the treatment. So it's a very conservative pricing. We would have $600 million of sales. And the total addressable market bladder cancer is enormous. There are over 800,000 patients that are treatable in the lifetime. And analysts, because companies are public now, following this, they reckon the market will be worth 21 billion by 2034. FDA pathway has been confirmed by the FDA. We have 3 pre-IND meetings. They've been led by a gentleman called Jonathan Jarrow. Jonathan Jarrow led the FDA. He was at the FDA, and after just under 10 years, he left as the chief medical officer. He wrote the guidance for the indication that we're trying. So he was leading us on the, I suppose, the path of what he actually designed whilst he was at the FDA. We've also spoken to King and Spalding to confirm that we'll get our own J code for our own pricing in the US, and we've got an agreement, exclusive agreement for the drug that we're going to be using in the US with a large German pharmaceutical company, the only company that'll be able to make the drug that we need to be able to do it for our treatment. In terms of the team, both me and Alberto, serial entrepreneurs, successful. We've developed over 20 products and brought them to market throughout our career. We've been successful raising money. I've also led and product managed a 330 million IPO, done multiple IPOs and excerpts between the team. And our clinical advisory board reads like the who's who of bladder cancer and hypothermia. Paul Sugarbaker actually invented the peritoneal treatment that we give. We've got a worldwide presence. We're already sold in 35 countries. We sell directly in the UK and Spain through our own sales force and use it through specialist distributors outside that. We have an established business model. That means in Europe, we actually sell for 4,000 euros for the device only. But in America, when we have to get the drug approved, we become a drug company in the US. It's a drug device combination. It'll be a higher price. It's a disposable razor blade metal. We give away the system in terms of a minimum commitment, and we make all of our money from the single-use kits. It's a repeat revenue. Already our revenue blend is 90% single kits and 10% capital. We've got great margins, which are only going to increase as we go forward. We've got robust manufacturing supply chains, which are prepared to be able to scale. We could scale from the 20,000 treatments that we're doing annually at the moment up to 1 million very, very quickly, the way that we set up the business. And we have high expectations for sales. This is a forecast of our sales. One of the important funders that we forget about is Combat, because we're profitable and we're contributing. And you can see actually last year we grew 13%. We're only forecasting in our sales 11%. So conservative numbers, because we're conservative because we have to pay, fund and ensure the funding for the business. So conservative numbers are 19%. We've got some great clinical data that we're coming up at the end of this year and next year ahead of the FDA data that will be released, and you can see the progression before we get FDA approval and move into the US by 2029. So the problem, there's been no innovation that's affordable or effective in the world of most expensive cancers. Well, HIVEC has got the solution for that. We're much better than all of these guys. We're going to be considerably more affordable, got low side effects. which I know over 100,000 treatments. We estimate that compared to the other treatments of 10,000. In terms of our timeline and inflection, we're self-funding, so and we've got the trial approved, but we need 5 million to fund the 7 million trial. We've got 50% committed. We expect, this is the key takeaway, we expect to have interim data in 75 patients by the end of 26, early 27, at which point, if we get that result, then we'll have a massive value inflection. In terms of the ask, we've raised 20 million to date. The pre-money value today is 38 million. If you compare that to drugs that are a similar stage to us, that'd be 180 million for a public listed company on the NASDAQ at the moment. So it's a huge discount. We've got 200.7 committed. We've already had another 310. That's nearing actually 500,000 in terms of soft commitments since we did a roadshow just over a week ago. The offer is for ordinary shares in terms of the price, but we're offering, if we get the discount, if we get the round investment closed by the end of September, we're offering a 1-for-1. So every ordinary share you get, you'll get one warrant, which will be provided at a discount at any event in the future in terms of an IPO or closing or a significant investment round where you'll be able to transfer and get those shares at 25% discount to that future round. We've got good discussions ongoing with J&J and Boston Scientific, and also spoken to Teleflex not so long ago in terms of potential trade sales for the bladder business. We've also recently gone through the Keiretsu Northwestern Rockies, and we've published our due diligence report, which is now available. I'm more than happy to provide that to you. And I'll leave you on this side while you ask questions about in terms of the timelines of what we've got over the coming years. Thank you very much.
Great. Thanks for the presentation. First up, Josh, what's your first question?
Yeah, compelling discussion. There's a lot of information here. I'm curious on this current, raise, why you feel like it's not been filled. I feel like you made a compelling case. Just walk me through what you've been hearing from people on the current round and why or why not they're interested.
So the venture capital market is really very difficult at the moment, and we went to them in 23 and they asked for more pathway to be defined, and then we had the 3 pre-IND meetings and they asked for more clinical evidence. I went back to them and they said, well, now we actually want you to have the clinical evidence from the trial. But I said, well, companies are floating for 1.8 billion off the back of those data. So if you want to get your 20 times X, you have to invest now. And at that point, we decided to go back to what we know best. We're not giving up on the VC market, but we're focusing purely on our existing investors and high net worths. And that's where we've got the 2.7 million committed. And then at the end of April, we started moving into the US market because it's for US cause and we want to improve our profile. And we've been going through the process, which is ended with working with 10 and Keiretsu to create a due diligence report and some type of supporting evidence, which is what US investors require more so than type of European investors. And now we've been doing several road shows, and like I say, we're very confident we're going to fill out the books. We're dealing with type of something about 50 investor inquiries at the moment.
Great. Mohammed, what's your first question?
Hey, Edward, thank you for the presentation. Really interesting. I have 2 questions that come. First of all, you just answered one of them, but what is your ideal backer? Like right now, would it be more like a financial family office, or I saw Boston Scientific, Johnson & Johnson. If you had your preference, who do you see as the ideal backer for the stage that you are in right now?
Johnson & Johnson won't come soon enough, and we're in discussions with them, even though they are a competitor. I suppose in terms of from our side is that we see this as the stepping stone. We want to be able to have exposure. So I suppose family offices that are connected have potentially more value than individuals raising, $100,000 or $50,000, multiple times. And to be able to connect and have that exposure. But then again, we're finding from the discussions from individual investors that the connectivity within the US investment market is really quite extraordinary. So individual investors can be very powerful because they have good networks themselves. So we're not really particularly fussy, but I suppose less is more in terms of having to do less presentations, but we're already presenting. So at the moment, I feel I'm quite happy with type of either smaller investors or the larger investors, because this stage is about getting the trial funded and completely paid for over the next couple of years, so we can get to our end goal and get to the inflection point.
Great. Thanks,
And
Mohammed. Go ahead. You have one more?
thank you. Yeah, I was just wondering, given the big disparity between the patient value in Europe and the US, are you going to prioritize the US market over the European one after like you raise the funds, basically?
I don't think, I mean, we've already got an established base. We're in 350 hospitals already across Europe, and will grow, and the demand will grow. I don't think you can prioritize either. They're going to be different sales forces, different groups of people that are taking it to market. And the clinical evidence, once you have that, and the guidelines committees, once they've seen that and it becomes the standard of care, it will drive it. We have no problems in capacity in terms of being able to deliver product or drug. So I don't see what about a priority. You would just make sure that you have the right capabilities to be able to really exploit and get as much out of each of the markets as you possibly can.
Okay, thank you.
Thanks, Mohammed. Ram, what's your question?
As I understand, you're successful in making money in your procedures business, correct? In other words, you have two parts to the business. One is the procedures, and now you're trying to introduce a drug to go with it. Did I understand this right?
No, that's not correct. We sell a delivery system, which is a consumable, and in Europe, the doctor chooses the drug to put with that. There are multiple drugs that they can use. There are 2 or 3 drugs that they commonly use with that. In
Right.
America, because the drug, whilst it's approved, is not indicated for bladder cancer, which is astounding. So about 1 million treatments every year in the US are given for the drugs that are used for bladder cancer, but they're not on the labeling. So when we went to the FDA said, well, the drug's not approved for bladder cancer, so you have to get it approved first before you can use it. So we're getting it approved. So it's a drug device combination, but it's still the device we're selling. But in America, it's going to be sold in together as a combination product.
So, because I thought you at the moment, one part of the business is producing income and you have an EBITDA and everything else, and you're now trying to do this combination because the FDA requires you to do that. Am I right in saying that?
So you have a device, a consumable kit, and that consumable kit is the doctor buys it and then uses it, but he then puts the drug through it. So the doctor in the US could do that, but in the US we're going to have to get the drug approved, even though it's a drug that is 40 years old. In fact, the one that we're going to be over. So in America, we become a drug company, in fact.
Right. The reason being that anytime you look at clinical trials and everything else, it's a long and tough road ahead. And
So we started the clinical trial. It's enrolling, should have its first patients done. We've got the trial set up, and we expect to have the interim data and to complete the trial 2 years from now. And we expect to be able to submit that data to the FDA in 2028. The trial's already enrolled. We've got the first 2 hospitals that can take on patients, and the first patient could be enrolled. And we need 100 patients in terms of for the FDA approval. So we've got 25 hospitals to recruit those patients in 2 years.
I echo Muhammad's question, that is, would your life be a lot easier if you were to align yourself with an institutional company like, Johnson & Johnson, whatever, and they take on the responsibility of funding, and you have a great product combination, excepting that you're looking for this.
We've already started. We only need 2.3 million. We don't actually need that now. In fact, we only need in terms of to be able to pay for the trial, we need less than 1 million out of the money that we're raising. The rest is to create a buffer. So we're just doing this on our own now because institutions have missed out on their opportunity to invest. They've taken a conservative view on us, and so we're just going to go and get the phase 3 data. And this is an opportunity for smaller investors to be able to get a massive return at a lower valuation.
Okay, we are out of time, guys. Thanks so much. Good presentation, Edward. Appreciate that. Thanks, Ram, Mohammed, Josh. Great questions. Let's move to our next presenter. We have with us next Fintegrate. Chris, if you could launch your slides and kick off when ready.
All right. Do you guys see the screen there?
Coming up, we see the screen.
All right. Thank you. So my name is Chris Bishop. I'm the CEO and co-founder of Fintegrate Technology. We are a fintech company based in Birmingham, Alabama, that's focused on automation for collections and recovery systems for banks and credit unions, as well as fraudulent dispute management. So our goal is to really automate that entire process from start to finish for our banks and credit unions. And there's about 9,500 banks and credit unions in the U.S. today. Believe it or not, if you're not familiar with this sector, they run some very old, antiquated software. And many of these guys are tracking your fraudulent claims and your chargebacks, your check fraud, even your credit card, debit card fraud on a spreadsheet. And then a lot of the community banks are getting fined on a regular basis by the FDIC, the OCC, the CFPB, all these regulatory agencies because they don't have a system of record. They're doing everything manually, and they don't give the customers the response times and the credits that they're necessary, that they're required to do. So, and our process basically automates that. Our systems do. We create a CRM or customer system of record for all these processes, as well as help them collect, and we can cut their operating cost by as much as 80% over a manual process. We have 3 products in the market today. Fusion CRS is a collection recovery system for banks and credit unions. It's been in the market for about 12 years. I acquired that business 3.5 years ago. Fusion DMS is for dispute management. So any type of check fraud, debit card fraud, credit card fraud, ATM wire, any type of fraudulent transaction that a bank processes or has to deal with, we track that from intake through resolution and reporting. What that means is the customer can go to the website, they can click on the links, this is a fraudulent transaction, they can pick up the phone, call the teller, call the bank, claim fraudulent transactions, and then that's when our system kicks in. So there's a series of questions that has to be asked to determine which type of fraud, which transactions, how many transactions. There's some credits that has to be posted back to the customer's account depending on the type of fraud, and there's some time frames. We automate the entire process, as well as keep the auditors and regulators up to date for the reporting on that process to make sure the bank and credit unions are in compliance. Our third product is Fusion LRS. It's kind of a version 3.0 of a company that I've built and sold twice before in the banking merger and acquisition space. So if you think about it, when 2 banks merge, there's 2 different systems that house all your historical data, all your statements, all your check images, all your reports. We take all that data, move it into our browser, where they'll use for long-term research, or we'll convert it and move it into their new system for go-forward processing. So again, our whole lifetime, the last 3 companies have been spent, 4 companies actually have been spent doing back office banking integration and automation for banks and credit unions. We've helped actually more than 5,000 banks and credit unions in the 22 years we've been in business, over the 22 years we've been in business. So, and our goal with the new AI and everything that's coming out is towards the 4th quarter of this year is to really start working with more of the AI and agentic processing to automate the entire process for collections and recovery, as well as dispute management in that process. But as you can imagine, banks, especially community banks, are very leery about AI right now and adopting new technology because it is their reputation that's at hand. They will get there, but community banks are never the first ones to adopt any kind of new technology. Speaking of that, so we serve an addressable market of about 5,500 banks and credit unions in the U.S. We have customers that are $200 billion in assets. We have customers that are $100 million in assets. So our products and services range the gambit of those asset size from a very, very large super regional bank to a small community credit union. But there's about 5,500 of them kind of in our target sweet spot, which is between 20 billion in assets down to about $150 to $200 million in assets. That's really our sweet spot that we target every day. On the left-hand side, you'll see some names of some banks and credit unions that are our current customers today across the U.S. We have over 100 customers, 105 or 6 today, I think, across all 3 products. On the right-hand side is a list of the largest core companies in the United States, and that's the core banking system that all banks and credit unions use to operate. They don't all use these. There's others out there, but these are the largest, 5 or 6. Most of these are multinational companies that are based here in the U.S. I've sold a couple of companies to a couple of these public companies already. in the banking merger and acquisition space. If none of these companies have products or services like our Fusion CRS or like our Fusion DMS today, and some of these are actually referring or reselling us business today as well. DCI has signed up an exclusive, we announced last week, an exclusivity offer with us for some of our products and services. Our management team has been together. Jason and I've been together the last 3 companies. I've hired him out of college 20 years ago, and he's been with me ever since. We've grown and sold 2 separate companies together. Kerry Nelson was he built Fusion CRS, the collection recovery product and company. I bought that from him 3.5 years ago. He's still on serving as our president today. In the past, I've always bootstrapped my companies myself. We invested organically and grew organically till we sold those. Today, our management team and our employees have invested a little over $1 million of their own money, and then friends and family, we raised $2.2 million when we started the business to buy the existing Fusion CRS product. A little bit about what we've done in the past there, just some of our 4 previous company exits that I've done. Again, sold 2 of them to a public company, sold one of them to a very large private equity company, was the last one I sold. And just some opportunities for what we're doing at Fintegrate, kind of in those same spaces. I'm going to ask Ray Martin to step up and talk about the financials now, Ray.
Hello, everybody. Can you hear me okay?
We can.
Yes, we can.
Okay. Hi, I'm Ray Martin. I'm not part of the management team, but I am an investor in the company. I invested early on and knew Chris and Jason, his co-founder, from a previous company that I bought from them in 2019 called Nextsoft. And we bought their last company and got to know Chris when he put this company together after staying with us for 2 years at Nextsoft as our chief revenue officer. He started this business, Fintegrate, and I asked to invest in, and he graciously said okay. And so I'm helping him with this fundraise. So they've done a really good job with the revenue growth. Also a really good job managing the costs as well. Embedded in those costs and in those loss numbers is about $1 million of cash payments to the original purchase of the Fusion CRS application. Chris's experience as a bootstrapper has held them in very good position in terms of cash management. But to finance this convertible note that we've offered, the $1 million, is really to finance the growth. The company has done a really good job of getting the applications to a good product fit level. We've got about over 100 customers now that are enjoying the products, and we're really ready to ramp out and expand and go out to market the addressable market that we have. And we need some capital to do that, to add some salespeople and marketing mostly. Next slide, Chris. So it's $1 million convertible note, valuation cap, very standard terms, 12 million, 20% discount, post-money valuation, 3-year term, 7% interest, minimum investment. $1 million, basically that's used, as I said, mostly for sales and marketing. We've got another software development, or actually 2 more software development people we want to bring on, and some additional working capital, but that working capital is really going to go to sales and marketing as well. Next slide, Chris. So we have a little bit of an update here. So we raised about $700,000 from the Baylor Angel Network, and they took a board seat, and that would have left about $135,000 to get to our $1 million target. We decided to do an over allotment of $300,000, so to bring the total convert up to $1.3 million. So the updated available amount is $435,000. And again, really development work and sales and a little bit of admin stuff would be the expanded uses. We feel very confident about the exit of this company because I have an investment banking background. I was in New York for over 30 years doing investment banking, and this business is, a perfect add-on for a number of different business segments in fintech. But you really got to get to that $3 to $5 million range in revenues and annual recurring revenues to get people excited and to get them to pay you kind of multiples in the 7, 8, 9, 10 plus range. One of our competitors just sold at a 15 multiple, for example, but we're not projecting that here. But even at relatively low multiples, we think the IRRs on this are pretty good. And you're at the top part of the capital structure since this is a convert. And so we think relatively low risk and pretty good returns available. And so just in summary, good revenue growth, proven software, we get over 100 customers. The management team has had 4 successful exits. Again, I purchased their last company, and it was a great business that we bought from them. They've got a very focused but large addressable market, over 5,000 banks, and we've got 95 or 100, so there's a lot more to go. Management has invested cash, and more importantly, their friends have our friends have put cash in, and then strong exit prospects.
Yep. Thank you, Ray. So
Great.
I'll open up for questions.
Great presentation. Mohammed, what's your first question?
You may be
Sorry,
on
I
mute.
was muted. Thank you for the presentation. I have 2 questions. The first one, when I see first of all, thank you for the presentation, very informative. When I see the revenue from 2021 to 2024 going from 247 to 1.7, that's almost a 6x, but cost only doubled. Can you talk a little bit to that? You actually said they're doing a good job maintaining cost, but I'm just trying to understand how come revenue was able to almost 7x and cost only doubled.
Well, for a lot of that time, Mohammed, we really had 1.5 salespeople, right? Coming and going there. And in my experience, as you build the company, I like to build it, as I said, organically based off the revenues that we have. We changed our revenue model. The Fusion CRS was a great product to sell to all credit unions and only some banks, right? So what we realized early on after I purchased the company was if you're not a retail-oriented bank, you probably don't need a collection recovery system because you don't have enough retail loans out there, right, to justify that. So we needed a product we could sell to all banks, and that's where we created the using the workflow engine out of the Fusion CRS product. We updated, brought it to the cloud, and created the Fusion DMS for dispute processing, dispute management. So now we have a product we can sell to all banks and all credit unions. And there was no real competitors in the market space to speak of. And we know banking better than we know the credit unions.
No, it seems like it. That's for sure, Chris. And to me, like, the question is not negative in any way. I think it's a great sign that you have good margins, right? So was just trying to understand, hey, what was the key driver? And if it's bootstrapping it, it shows that growth is there. If I may hold one more question, on the TAM, that's where I'm having a little bit of a moment where if we say there's a 5,000 regional bank, and please correct me if I'm wrong in my assumptions, but you are saying that your 3 products are 45K, 24K, 24K. So on average, I'm going to give it a 30K average. If we get the whole 5,000 banks, that would be 150 million in revenue. So what's your market penetration, or how much of that size of the market are you aiming to get after or get?
So if I'm understanding the question right, Mohammed, there's 5,500 banks that we target today, right? In that 20 billion in assets down to about 200 million, 150 million in assets. We have a $200 billion bank. They pay us 70, 80 grand a year, cost them $500,000 to buy in, right? So there are outliers. We also have the $150 million banks that pay us, $500 or $600 a month for like $25,000 buy-in. So the 3 products, the collection recovery is a full integrated product with all the other core systems, with legal, with phone, with every system at the bank. It's a lot more expensive product. There's a longer sales cycle. The dispute management product is a simpler product to sell and market with a shorter sales cycle. So we feel like we can get more customers there faster because there's less competition. It's an easier sales cycle. And then the Fusion LRS, those are announced acquisitions. So there is a definitive cutover date when the Fed announces it. So everybody's working backwards from that date. So we have a hard cutover, typically a 60 to 90-day sales cycle for that product. Did that answer your question?
Okay. Yeah, thank you, Chris.
Okay,
Thank
good. Thanks. Good question.
Great. And Ron, what's your first question?
Banks, really, if you're dealing with the fraud and things like that, the regulators must be pounding them too. If anything else, they must be pressing the banks to say, get this thing taken care of. You're giving me the information that the technology people are using is very old and manual, and I am surprised that you would not be meeting a lot more demand, and you have to. I mean, this is a product that should be pretty welcome product. Am I correct in saying that?
You're absolutely correct, and that is what keeps me up at night. Is not our product; it's the opportunity out there, and the fact that we now have 3 salespeople, right? Instead of 1.5, we went ahead with the money we've raised. We've hired some more to go after that addressable market. And the competition, as Ray said, there's 2 competitors in that dispute management market. One of them was just taken out by private equity at 15 times earnings, but they only serve the top 30 or 40 largest banks in the country, which is not our market. The other ones kind of really serve the bottom tier of kind of the low-cost leaders of credit unions and banks. But now they are coming into our space, so we do have a competitor there, but they're also looking, at an acquisition there. So I think we can completely dominate that market, and that's our goal.
Great, thanks. Next question from Josh. What's your question?
Hey, Chris, enjoyed the presentation. I'm in Nashville, so just a little bit north of you. Looking forward to following up after this, but talk me through the AI layer. What is the use case, the purpose? Are you doing that all in-house? Why or why not? It said in your slides AI ready, but I'm not sure really what that means or what direction you're wanting to go.
So AI ready is a great term, right? Like we're all AI ready. So we're using some machine learning today. In our process, we do delinquency risk scoring or the ability likely to pay scoring. But it's basically based on 21 different data feeds we take in from different payment centers, from your FICO scores, from all these different data feeds to analyze your payment history, your transaction history for the month, and kind of rank your scoring. I wish I could tell you what our actual, development path was for AI. But right now we're kind of unsure, just to be honest. We got a developer that's worked with us that used to work for me at my last company. He left. He's been in AI for healthcare for the last 2 years. He's now back working for us. So we're kind of developing that strategy. Honestly, we can't just jump out there with all these banks and go, hey, you now can be completely AI, right? Because community banks and credit unions, they don't do that, right? It's their name, they're responsible for whatever we put out there, right? From a legal, a regulatory, and a financial standpoint. It's not us that's on the hook, it's the bank. So they're very leery to jump off in there. But at the same time, there's tons of opportunity to aggregate those different automations, if you will, that we're doing with manual processes today, or we're doing with machine learning today, rather, and kind of start leading them down that direction. So I don't have a direct answer for you, but Josh, that's kind of what we're developing, and that's what we're going to get off into in the fourth quarter with Victor, and probably we're going to outsource a lot of it just to start seeing. We've been interviewing companies to see what's out there. I'm going to a meeting in Banff, Canada in a couple of weeks where they're all fintech companies, and there's several of them that are just focused on AI and fintech development.
Hey, Chris, can I add a little comment
Sure.
to there too? This is Ray Martin again. So I think that, well, of course, Jason Alfano is our CTO and the co-founder of the company, and built 2 other businesses with Chris. I think with AI, our ultimate goal would be to really automate as much of the process as possible to the point where, we built AI agents on top of what we already have that would handle a lot of what the human interaction is for these banks. But you have to realize, so that's the goal. The goal is to just, over time, incrementally take more and more of the hands-on processes away from, humans that are doing this work at the bank and make them more automated. And the other thing that's really important is that Chris and Jason are data scientists. When you're in the fintech business and you're moving bank data around among their core processor, their own books, and third-party software providers, it is a morass and maze of data that you wouldn't believe. These guys and their developers and their operations people really understand how those datas flow. And from that, you can build AI agents that would get you to that AI automation.
That's great. This would be a great conversation to continue in the breakout rooms. Thanks for a great presentation, Chris and Ray. Great questions, guys. And let's move to our third presenter, which is Buddi. If Layla could launch her slides and kick off when ready, we'll kick off here in a moment.
All right. Hello, everyone. Thank you for your time today. I appreciate you guys listening. I am Layla, and I'm the co-founder and CEO of Buddi. You might be asking yourself, what is Buddi? Well, imagine that you could take the $137 billion pet space and match it up to the only growing part of entertainment, which is niche streaming. If you put those two things together, you get Buddi. Buddi is a specialty streamer. It's designed for Gen Z and millennial pet parents. We're available in 90% of homes right now. We feature a mix of highly bingeable and commercial-free content that's pet-centric. So what does that mean? That means it is content that is family-friendly, that features animals in all of the content. It's not for your animals to watch, it's for you to watch with your family. We have a mix of creator-made originals, so think influencers, original programming. We have licensed movies, series, and documentaries, and a lot of health features, as that's one of the main reasons people really, really consume pet content. Buddi will reach profitability with only 75,000 subscribers, and we are very affordable at $7.99 a month or $79.99 a year. Many of you probably subscribe to Apple TV, and this morning you got a fun little present in your inbox, which was, we're raising our prices from $9.99 to $12.99. That's just the latest and greatest of streamers that are raising their prices. Hulu did that a few months ago, Netflix as well, and YouTube, which is something people ask us about a lot, is currently sitting for commercial free at $14.99 per month. So what does the pet space look like? 66% of homes have pets. That is one in three homes own a pet, according to Forbes. There's $137 million that was spent on their pets in 2023. They are very, very passionate group of folks that will do anything to support their pets and really enjoy being with their pets, talking about their pets, highly engaged, very, very sticky consumer. And then when you look at the niche streaming market, you're looking at about several niche streamers that have come out right now, several of which have been acquired by the larger media companies, more to come on that. But people really want to be spoken to on a one-on-one basis. So if I'm really into something, I want to be able to go to a place and consume content on that. So if you go to Netflix right now and you search pet, you might be saying, well, I'm sure there's pet content on Netflix, on Hulu. Very hard to find, very difficult. If you type into Netflix pet, you're likely to be served up Pet Cemetery, which I think we all agree is not pet content. That is not something you'd want your family to watch and not going to give you any kind of entertainment value if you're looking for pet content. Only Buddi has their favorite content creators. We're commercial free. You can play it on demand and you have the ability to binge. So when you look at what people are looking for, they really want to watch the shows they want to watch. They want to watch the people that they know. They want to be able to binge it. They want to go episode after episode in their own time. And they want it on demand. They don't want to watch it on your schedule. They want to watch it on theirs, and they don't want to watch commercials. So when you think about that, there are a few streamers that do something similar, but not exactly. So Buddi is for people. It is on demand. There's no commercials, has original programming, and is very niche down. There is something called Dog TV you may or may not have heard of. Dog TV is for your dog to watch. So it is going to be in the colors that they can see. It is for you to leave on when you go to work so your dog is not lonely. You might be wondering, does that work? Well, 400,000 people are subscribing. They've been around for a very long time. They've got several subscribers. It's working. And they're sitting at currently at $9.99 a month, unless they've also taken a price hike. Bark TV is something that people ask us about. That is not on demand. It is full of commercials. It is not original programming. They're actually showing some of Buddi's content right now. Some of our original programming is already streaming on Bark TV. What does this market look like? Well, there's 87 million people that own homes. If you double click on that, the serviceable TAM is 61 million. So that's pet parents who also stream any streamer. So think about anyone that's got Hulu, Netflix, all of the streamers, that's that market. Now, if you really double click on that and we look at people that are pet parents that are watching specific influencer shows within the last year, that's 5.5 million. And that is our initial target audience. That's who we're going after. The top 3 acquisition channels, we have worked with a company called Media Plus. They have built our media strategy, our targeting strategy. They were actually the agency that took BritBox from 0 subscribers to 500,000 subscribers in less than 2 years. If you're familiar with BritBox, you know that is a very niche streamer, and they were successful with them. They've built our campaign, and we are pending this seed round to be able to deploy that program. We've got influencer and content creator campaign going. So once funding happens, we will be reaching out to these highly sticky influencers. You see them on Instagram, you see them on TikTok. Those folks, we're currently doing some programming with some of them original programming. They will bring their viewers with them over to Buddi. And we're building partnerships with existing streamers. As I said, Bark TV is one of them, and other subscription lifestyle bundles. So think about, there are several of these bougie dog parks that are private. So you pay a subscription fee to take your dog to the private dog park, not the public dog park. So partnering with them to bundle our subscriptions together is work that's happening. The customer persona, this customer is, again, very, very, very passionate about their pets. They're culturally geographic, and they're a diverse group. And they are early adopters of innovation, and they're receptive to advertising. They can be influenced. The team that's bringing this to you is myself. So I'm currently the CEO. I'm a CMO, a publicly traded company. I took that company public in 2018. I am a data and consumer segmentation expert, along with branding and marketing. My husband, also co-founder and COO, Ryan Sullivan, is our very steady and smart strategic executor who will be handling all of the execution day to day. He has successfully led multiple media companies through acquisition and deals with media and production. And then we have Nathan Fletcher. Nathan Fletcher has been with us. He's got 30 years of experience in licensing and programming, and he's been part of Great American Family and Ride TV, and he successfully exited Ride TV to an acquisition a few years ago. So what have we been up to? We've been building this platform. We have been getting it on every app known to man, being able to download it from Apple, download it from Google Play. We've secured Media Plus. We've got that strategy going. We've cleared 91% of the CTV. So if you open up your Samsung TV, that took almost a year. Samsung is the last one to come on in. So now if you open up Samsung TV, you can also download and stream Buddi through there. And we've identified the first platform of content creators and influencers that we will begin production with pending this seed round. What's on the horizon? So AI is a big part of what we do over here at Buddi, and it will be incorporated. It's really helping make our viewers sticky. So as we hear and see them in the community pages talking about an issue or a challenge, we use AI to create programming, short content that will address whatever's happening. So as an example I will give you is chronic kidney disease is one of the leading issues with cats. And so for us to go into AI to create short videos on how you can help your pet, how you can make them comfortable, what kind of foods you should feed them, things like that, we can do all that through AI and create the content. And that's how we've been using AI at this point. But Buddi Helps will become a huge part of what we do at Buddi. We will be building a proprietary platform that's coming over the next few years. One of the big things with Buddi that we're excited about is this ability to have shoppable episodes. So as an additional revenue stream, being able to scan QR codes throughout the episode or have other retailers or CPG brands sponsor content that allows it to be shoppable. So folks can go in, buy anything they see in the episode, and we would get a portion of that. And obviously they would, the CPGs would as well. And Buddi branded content, that's always something. So we are looking at the future here, potential exit strategies. The big one that we think is the big potential would be being purchased by another media company. So the strategy that has existed over the last few years with companies like Sony, Warner Brothers, they're acquiring niche streamers. There's lots of examples of this. Shudder was acquired by AMC a few years back for north of 250 million. Crunchyroll, you may or may not be familiar with. If you're not an anime person, you've probably never heard of it, or if you don't have kids that are anime people, but they were acquired by Sony for 1.2 billion. The larger companies don't want to be inventing and creating. It's expensive for them. So they kind of float the niche streamer market and they acquire them as they see benefit and see synergies with what they're doing and who that customer is. Niche streamers are building super, super sticky users. And so to bring them over to the main part of the business is what they want to do. We could be merging with a similar service. So think Dog TV, Bark TV, any of those could be a potential merger. We could be acquired by a big pet, I don't know what's going on with me, big pet brand. Someone like a Chewy or a Purina, think about that. Chewy would love to be able to have a content channel where they could push all of their product. They're a really great retailer that could be a potential. There's always the potential of a PE, an IPO, a management buyout, those types of things. So there's lots of opportunity here with Buddi. So why now? We're combining a cultural timing with category insights and operational readiness. The TAM is very large. We have a really great leadership group that knows this space very well and knows how to do this. And no one is doing it yet. Someone is going to do this and someone is going to be very successful at it. And we believe it will be us. We're currently looking for a $500,000 raise in a limited seed round through a convertible note. The discount is 15%. The interest rate is between 4 and 6. And we've got 125,000 interested and committed so far. This is an even split. It's a third on marketing, a third on programming expenses, and a third on sales. So we will be taking these funds, using the Media Plus plan, putting that out in the market, creating fresh content, more fresh content than we already are creating, in order to keep those customers sticky. The important thing here to note is that towards the end of this in 2029, at the end of our 5 years, we'll have a 23% EBITDA percentage. Revenue at 114 million, and the multiple on a media company right now is 8 to 10. So that is a very strong exit. We'd love for you guys to join us, and I'm happy to take any questions at this time.
Great presentation. Ron, what's your question?
The cost of production must be a big, major issue for you, isn't it?
So actually, no, you're looking at 3 production experts. My husband ran multiple production companies. Nathan as well has done a tremendous amount of production. There is a really great, affordable way to do production. And we know all those different things. And one of them is the influencers. So a lot of these influencers are creating content right now for their pages for free. They create them, they put them out, and we are talking to them. We take a lot of that content now. We give them some donations for their charities. A lot of these content creators are really passionate and in it for the animals. And so they will take a smaller fee because they're already creating the content. And by us paying them, it becomes exclusive. And so therefore they shift all of their subscribers and people that watch them become very sticky and come over to our platform.
The second question is there a abundance of these subscriptions, and you know everybody has a half a dozen subscriptions? Is there a subscription overload? And over a period of time, how long will these people? I understand my daughter has a dog and everything else, so they're very passionate. But after a while, how long is this is sticky revenue that they will stick with this process?
Yeah, so people have on average 8 to 10 streamers that they're paying for. People tend to not cancel, especially when they're on the affordable side. So if you continue to keep increasing, that's when people are like, do I need this? And if you're getting the right content, so meaning if I follow a dog trainer as an example, and they move their platform over to Buddy, and I'm following that person, as long as you keep that content fresh and they're connected to that person and you're not charging them an arm and a leg, they're gonna stay and they're gonna stay sticky. Now, we're new and we don't have, I couldn't tell you on average or what our, what that's going to be, but we are based on everything else with pets and with streamers. We feel very, very confident that this customer will be sticky as long as we keep that content coming for them and we're still speaking to them one-on-one.
That's great. Josh, what's your question?
Yeah, Layla, thanks for the discussion.
Yeah.
Could you walk me through, maybe I missed it, the price and then also the traction you've gotten with like current customers and anything else that's relevant on traction?
So I could probably talk about that, Layla. So I'm Ryan. I'm the co-founder and COO. Our price is currently $7.99. We are really pre-revenue. So we have done, for lack of a better term, beta launch testing. We've got a lot of friends and family on there. Some customers from events that we've gone to, but we're really looking to do a hard launch with this seed amount of capital.
I see. Thank you.
Mhm.
Hey, and Mohammed, what's your question?
Hey, Leila, thank you
Hi.
for the presentation. I have a puppy myself, a dog, so I like the idea. Two questions for me. What is the ideal exit time frame for you? Like you talked about an exit already and you are pre-revenue. So I'm just trying to understand, are you trying to build the business for the long term? Or are you really trying to, through your distribution partnerships, the vision that you have, try to sell it quickly?
Yeah, look, we're not looking for an exit till at the earliest, the 5-year mark. And I mean, we're building it for the long haul. The reason for the exit talk is because that seems to be the first question investors want to know is how are you gonna get out of this? I am a proud pet mama, Ryan, proud pet dad, and Nathan has, I don't even know at this point, Nathan, I've lost track. I think he has like 6 dogs or something. Like, we're very big pet people. We love the space. We understand the space. It's why we started it. So for us, it's a long-term plan.
Understood. And finally, you touched on something that caught my attention about the dog walker. Can content creators make money through your Buddy platform, like YouTube? Like, can an individual third party put content and be rewarded for the views that they get? Because I think we live in a world where streaming, you have the Twitch of the world, the Kicks of the world that are able to generate millions of dollars for their content creators. Are you trying to think like, hey, I'm going to try to create content without having to finance it myself, but I'm going to make it easy for this niche area to become the platform for them? Because there's always YouTube that can be kind of your competition in that. So how
Layla,
can you differentiate yourself?
Let me take this one. So Mohammed, great points you bring up. One of it is with YouTube. So YouTube is a competitor, but it's also a tool we're using. So right now you will find all of our original content that we've produced throughout the year on YouTube. We currently run it exclusively on Buddy for about a month, and then we put it on YouTube, right? And then it serves on as advertising to go to Buddy. Very good question with the creators. Now we want to be able. Right now we're on a program and a platform called Uscreen, which is you can skin it to any streamer that you have. We are on it and it's skinned to Buddy, right? But this is why we want to build our own platform in 2027, because we want to be able to do things like that. However, for these first couple of years, what we're doing, Mohammed, is we're targeting influencers that have followers, but they haven't monetized. So they have about, like an Instagram, very good number would be about 9,000 to 10,000 followers, right? They're creating content and they're not making a lot of money, but man, they're creating daily content. What we can do is say, hey, we're going to pay you, not a lot, but we're going to pay you maybe that is $50,000 a year, right? We still want you to throw out a daily program. And somebody asked at the last event, well, how do you know they're going to do it? And I said, because they're doing it right now for free. So, and of course there'd be contracts and things like that, right? Then they can say, hey, this first 5 minutes of this content is on my site, but for the rest, you've got to subscribe to Buddi. But then also in 2 years, that's something that we're talking about, is having our own platform. So then they can also, we can work back and forth on making each other money. So we become really good partners to each other.
Understood. Thank you.
You're welcome.
Great. Well, that brings us to the end of our presentations today. Thank you guys so much for all the great work there. I want to thank our panelists as well, Josh, Mohammed, Ram. Thank you for doing that. At this point, we're going to go ahead and move into our breakout rooms. We have a presentation, but we'll use it for another time. I will be in a presentation room if somebody would like to talk to me about 10 Capital or what we're doing here. And then we'll also have Fintegrate in a room and Buddi in a room. Combat Medical is not able to join us, but let's go ahead and move into the breakout rooms now. And want to thank everybody for joining us today. After the breakout rooms, you're welcome to step out, and looking forward to seeing you guys next time. Again, thank you everybody for such a great presentation. I'll see you in the breakout rooms.